Here's one of the biggest puzzles in all of finance. We all know the golden rule, right? Buy low, sell high. But so often our own instincts push us to do the complete opposite. Why is that? Well, it turns out our brains might actually be hardwired to sabotage our own investments. Let's dig into the science behind it.
You've heard this a million times. The gold standard for rational investing, straight from Warren Buffett himself. Be fearful when others are greedy, and greedy only when others are fearful. Sounds pretty simple, doesn't it? It's like a clear North Star for any investor to follow. But if the path to success is so clearly laid out, why do we constantly find ourselves sprinting in the other direction? Buying into all the market hype and then panic selling the moment things go south. That is the big question here. And to answer it, we really need to look at the science of what's going on in our own minds.
To start this journey, we're going to head straight into the lab and see what happens when you put a trader's brain under the microscope.
So, researchers at the National Bureau of Economic Research did just that. For 5 weeks, they followed 80 day traders, and they tracked two things side by side, their daily emotions and, you guessed it, their profits and losses. This gave them an incredible, direct window into how our feelings really impact our financial results.
And their biggest finding is right here on this chart. Just look at the two bars for a second. The bar all the way on the right, that represents the least successful third of the traders. See how much higher it is? That shows they had a way stronger emotional reaction to their wins and losses. So, put simply, the more their mood swung with the market, the worse they did. The top traders, on the other hand, they were much, much more emotionally steady.
Now, here's what's really fascinating about this study. It completely debunked a super common myth. We all have this picture of a Wall Street personality, right? Aggressive, extroverted, a total risk taker. But the data? It showed absolutely no link between those personality traits and success in trading. Turns out, all different kinds of personalities could perform just as well.
Okay, so if personality isn't the key, then what explains this huge gap between knowing the right strategy and actually being able to do it when the pressure is on? To get that, we need to go a little bit deeper into how our brains are wired to make choices in the first place.
And the answer, it turns out, lies in a really powerful psychological idea that explains this constant battle that's happening inside all of our heads. It's called dual process theory, and the main idea is pretty simple. Our brain basically operates using two completely different systems for thinking. And the crucial part? These two systems are often in direct conflict with one another, especially when it comes to making decisions about our money. So let's meet the two players in this internal drama. On one side, you've got System 1, let's call it the gut. It is fast, it's automatic, it's emotional, it's intuitive. This is your knee-jerk reaction. On the other side, you have System 2, the planner. This system is slow, deliberate, logical, and analytical. It's the part of your brain that actually does the math and thinks things through. You can already see where the trouble starts, can't you?
So, what happens when this internal fight plays out in the chaotic up and down world of the financial markets?
And here is the absolute kicker. Even if you have a PhD in finance, your planner is as trained as it gets, it can be completely overruled. When markets get stressful, the gut can literally hijack the controls from the planner, and all that deep financial knowledge you have just goes right out the window. This whole thing is called an emotional hijack, and it happens in about 4 steps. First, there's a stressor, market volatility. That stress then activates your brain's fear center, which lets the gut take charge. This emotional response then short-circuits your rational brain, the planner, and just pushes it to the side. And the result? An impulsive, irrational trade driven by pure emotion instead of logic.
And this isn't just something happening in your head. Oh no, this stress has real physical effects that tons of traders report. We're talking about headaches, fatigue, trouble sleeping, even a racing heart. Your body is literally going into a fight or flight response over some red and green numbers on a screen. It's wild.
Okay, so we've seen the problem and the science behind it. So what is the real key to success here? How do you actually tame that inner trader?
The biggest takeaway is this. The fight for investment success isn't really fought on the charts and spreadsheets of the market. The real battle is an internal one. It's waged between your two competing systems, your impulsive gut and your logical planner.
So let's boil this all down. What does this really mean for you? Well, first, emotional reactivity absolutely kills performance. The science is crystal clear on that. Second, this happens because of that internal tug of war between your intuitive gut and your logical planner. And the most important takeaway of all is this. Emotional discipline isn't something you're just born with. It's a skill. It's something that can be trained and developed over time.
And that leaves us with one final thought to chew on. Maybe the biggest risk in your entire portfolio isn't a market crash or picking a bad stock. Maybe it's the person you see in the mirror. The real question is, are you prepared to manage that risk?